Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance. Nothing else. Just life insurance.
Well,
yes.
Seems as though that is true lately.
Maybe other things. Maybe.
Sometimes.
We could teach you how to give your kids life skills, but no, never mind. That's a conversation that was going on right before we hit record. That should stay private.
A little too polarizing, perhaps.
Yep.
For a life insurance podcast, no less.
Oh, let me ask you a question.
Okay.
Given everything that's going on, you can take that to mean however you want it to mean.
I was going to say, which everything are we talking about?
Is now a bad time to start a whole life policy?
It's never a bad time to start a whole life policy.
Well, I'm glad. This is going to be the record-setting shortest podcast we've recorded, and we're good.
We want people to be curious enough to stick around.
We do.
So I guess the question you're asking, is there such thing as timing the life insurance market? See what it is?
Yeah. Right. Because people worry about these things when it comes to purchases of any kind, right? Like it doesn't have to be life insurance. The question is, with whatever the state of the economy we have, whatever your opinion of it is, or whatever your theories about what happens next are, is this a good or a bad time to buy whole life insurance?
Well, I'll put it this way. It's just as bad a time as it always is. How about that? Or as good. Either way.
Yeah.
Depends on if you're a glass half full or half empty kind of person. Well, I think timing matters when you're purchasing an asset. I won't be specific, but when you're purchasing an asset that's volatile in its price, timing matters.
Never heard of any of those. Can you give me an example, sir?
Life insurance is not volatile.
Yep.
So, I mean, the only thing that really changes in a whole life policy in particular is the dividend rate.
Yep.
So if you bought a policy now that has a higher dividend, I don't even know how you would classify a higher dividend rate, but let's just say for argument's sake that you thought dividend rates are headed down.
Okay.
Maybe they are, maybe they aren't, but you believe they are. Does that mean it's bad? No, because even the ups and downs of dividend interest rates are everyone is subject to those, no matter if you buy it today or tomorrow or next year.
Mm-hmm.
And if rates go back up, you'll still benefit from that.
So what I think I hear you saying is asset classes are going to move in patterns, are kind of related to one another.
Sure.
And you don't get any control over when that's going to happen.
Well, definitely not.
So
you definitely don't.
So on the one hand, you have these people telling you that you want to strategically pick the right asset class for the moment.
Right.
Is now a good time to buy stocks? Is now a good time to buy bonds? Is now a good time to buy real estate? Is now a time to, and so forth and so on. But the truth of the matter is, if we zoom out and we look at your lifetime, those different asset classes are going to behave the way that they pretty much normally behave.
Right.
Stocks are going to have volatility, but a relatively high anticipated rate of return.
Right.
Bonds are going to have less volatility, decent amount of income that comes from them, but a lower expected rate of return.
Right.
And trying to figure out how you're going to swap one for the other to time the best time to own one versus the other, that's very difficult to do.
As far as I know, no one's been able to nail it perfectly.
Mm-hmm.
Ever.
So strategically, what you really are trying to accomplish, if we're going to be honest with ourselves, is matching the right amount of asset with the circumstance that is best for you.
Sure. Absolutely. I mean, I guess you could make the argument, and some people have, that, well, now's not the time to buy a whole life policy. Now's the time to buy some other asset.
Okay.
Because there's more upside or
Bitcoin.
The other. Yeah, exactly. There's an argument to be made there. The X factor that everyone forgets about life insurance, and we don't talk about it all that often because it sounds a little hokey, but it's absolutely 100% true. Mm-hmm. The X factor is you don't know that you'll be able to buy it next year.
Okay.
Because there is a real component, there is a true underwriting component to this that's based on your health. So
both parties have to want to work with each other.
Correct. Meaning the insurance company, you can say, yeah, I want to buy that policy. Well, the insurance company's like, that's wonderful. Not so fast. We got some questions. We got a lot of questions, actually.
So what you're saying is stocks are hussies and whole life insurance is more the upstanding family's daughter.
There's an interview process. You got to meet the dad. You got to watch him clean his gun. I'm not trying to scare people, but
right,
it is true nonetheless. It's not solely a decision based upon the timing of interest rates or whatever other factors you want to consider economically. There is a component of it that's like, well, you can buy it now because you don't have any truly adverse health conditions. And you might a year from now or 2 years from now or 5 years from now.
That's a risk.
That's all I'm going to say about that, but it is a risk.
Yeah.
So
it's a risk that you accept if you want to defer because you think there's some better timing you're going to accomplish. From experience, some commentary on my side, I am unaware of any situation where somebody was able to overcome the change in dividend, whether it was low now, high later, high now, low later, by deferring purchasing. So in other words, there's a compounding effect with life insurance policies in general. Whole life insurance is kind of more well known for this, but the same principle applies to indexed universal life insurance.
Right.
That overwhelms any conceivable advantage that you would get from trying to time your purchase to maximize the peak dividend, for example.
Right.
I just don't know that to work with whole life insurance. And I also have not observed it work with indexed universal life insurance.
It'd be very hard to prove it. Like, you know what I mean? Because the other factor is, which we haven't even talked about, is that the underlying life insurance component of a whole life policy increases in cost with every year that you age.
Yep.
So even if you had a higher dividend rate, say 3 years down the road, and you waited 3 years, you may not get a better outcome because the underlying costs are higher now. In other words,
because you're aged.
You're 3 years closer to death as far as the insurance company is concerned. So
right.
Well, and as far as everyone's concerned, that's just the fact.
Most of us think that way. Insurance companies are weird.
Sometimes
they just think they're gonna die.
Sometimes I have to edit myself. I'm like, well, you said something that was super obvious, and then you backtrack. No.
Sometimes we do. We all do. And to your point about the possibility that you may just become ineligible, there's also the risk that the assessment is less favorable. So you have two things that potentially work against you. You're older, which means the expense is higher.
Yeah.
So now rate of return has to be even higher to overcome that. But you're also under the risk that you're maybe not as favorably looked at as you were 3 years ago, which further requires an even higher rate of return to overcome that. And those are things that are really hard to know and things that are really hard to build any kind of strategy around. Like even if you had some other investment idea outside of whole life insurance that you felt I should do this right now and then wait 3 years for this to pay off and then I'll buy the whole life insurance. There's things that can unfold that may not make that as solid a decision.
Yeah.
Especially if you are subject to volatility in that investment strategy. Whole life insurance, regardless of what happens to the dividend, is going to pretty much do what we expect it to do.
Yeah.
Like we have put a lot of whole life policies in force. And we've done it and watch dividend scales decline.
Yep.
And the delta in terms of where people thought they were going to be and where they are now, because they're being paid a lower dividend and have for a couple of years, it's not that much.
No.
And even if we look out 20 years from now, again, the change is not zero, but it's not that significant. And we don't know that dividends are going to stay right where they are.
Sure.
So the movement, it's not that much most of the time. I realized there was this time 35 years ago when interest rates were substantially higher and people bought whole life insurance with some assumptions that were woefully overstated, and time went on and they look pretty underperformed at this point.
Well, I mean, when I got in the business 26 years ago, dividend rates at all the major mutual whole life carriers, participating whole life companies, was well over 8%.
Yeah. Now
and
they sit
told
around
you about
6.
Yeah. And now they don't announce them anymore.
Yeah.
They don't tell you what they are now. So,
and as an aside, we bring it up a lot, too much. 8 to 6 does not mean something that you can go, oh, well, it's 2% less. Not quite, but it gives you a relative idea of the direction, which is down. And that's just the way
8% at two different companies doesn't even mean the same thing. So
does not. It does not.
So it's just a benchmark, so to speak. But my point being, everyone who bought a whole life policy back then, 26 years ago, hasn't gotten anywhere, has not received the dividends that were in the current illustration.
Nope, they have not.
They've not gone back up there.
No.
They came down and they've stayed down. So, but, and I think you put this in the notes that you put together for the podcast. This is sort of back to the volatility discussion. You don't have the sequence of returns risk in a whole life policy or an index universal life policy either, because your floor is zero.
Yeah, not to the degree that we typically worry about sequence of returns risk. Wouldn't want to leave people the impression that it's totally off the table with life insurance contracts. It's not. There are elements of timing changing results in certain ways. But the thing that we really, really worry about regarding sequence of returns risk is early on, when we start to distribute from assets, there's a market correction. Because that could very, very dramatically alter what will ultimately happen to the account balance 20, 30 years out.
Right.
There's a multitude of examples.
It will decrease the aggregate amount of distributions, withdrawals, income, whatever you want to call it, that you'll receive from said asset over time. Correct.
However, even sequence of returns risk is something that may or may not, the issue that is typically associated with sequence of returns risk, which is that big market decline when you retire, basically, that may or may not be a problematic event depending on your circumstances.
Sure.
Like those who are a little undersaved are in a lot of trouble. So if, for example, you sat down with your financial advisor and figured out that when you get to retirement, you need $1 million in your portfolio in order to retire comfortably, and you're going to take 4% of that, $40,000 a year. So you're going to withdraw that amount. If you only get to $800,000 and you retire, and there's a 20% drawdown in the market, you're in a lot of trouble.
Yeah.
If you get to $1 million and there's a 20% drawdown, you're still in trouble. But if things went really, really well and you get to retirement, you have $1.3 million and the 20% reduction in your portfolio, so long as you didn't decide, well, I got 1.3 instead, so now I'm just going to up my lifestyle, you're going to be fine.
Right.
So that's, again, depending on circumstances, sequence of returns risk is more or less problematic. But when it comes to life insurance, because of the way it functions, there isn't a concern so much with the sequence of returns. And you cannot time it to overcome the benefit of time. So what I mean by that is the earlier you buy it, even if you put less into it than you were originally hoping to maybe be able to have the money for, you will most likely do better because you have time compounding on your side.
Right. That is completely true.
The nuance, the very unique aspect to whole life insurance that people, I think, don't get immediately because they're so heavily stuck in the world of, I worry about, is now a good time to own stocks or bonds? Is it a good time to reallocate? How should I mix this? They're really, really worked up in that world where that is something people worry about for good reason. Mm-hmm. But on the whole life insurance side, it does not work that way. And even if you were going to go out and buy bonds,
your range of possible outcomes in a whole life policy is much more narrow.
Mm-hmm.
I'm sure there's some statistical way to say what I just said, but that you could articulate better. But that's the way I see it.
The distribution is more tightly wrapped around the median.
There you go. The dots are more in the middle.
Mm-hmm. That is one way of putting it.
Yeah.
Not
a lot of tail risk is what you're saying.
We've been asked a few times, like, what's the best way to get $1 million in my life insurance policy, right? And one response that they don't like very much is put something north of $1 million in there in year one and you'll be A-okay. But the other one that's very, very helpful, I think, but most people kind of miss the point, is start as soon as possible.
Right.
And it doesn't matter what's going on. It doesn't matter if we think we're at the highest level of dividends or the lowest level of dividends. If we let this thing compound over time, it's going to do great things.
Right.
We've met a lot of people who bought whole life insurance at different stages of their life or at different decades. People who bought it in the 90s, people who bought it in the 2000s, people who bought it in the 2010s. All of them are pretty happy.
Yeah.
And the ones that bought it, let's say in the mid to early 90s or even the early 2000s, when dividend rates were significantly higher and their original projection showed them they'd have more money than they ultimately ended up with, they're not sad or angry about the results, provided that they were reasonable people to begin with.
Right.
Like if you saw a proposal for whole life insurance in 1992 and said, well, gosh, if it's going to do that, why own stocks?
Right.
You found out why, because that dividend wasn't going to sustain. And now you're upset because somebody showed you a mountain chart of whatever mutual fund you could have bought and you'd have more money and you're angry. And that's still a little myopic, but you kind of learned a very hard lesson, which is the assumptions about that fixed rate asset were overstated.
Yeah.
Now, the assumptions about all fixed rate assets at the time were overstated.
Yes.
Bonds looked incredible.
Thanks for pointing that out. Money market accounts. I've told you before. I remember when I first got securities license back then, I think money market accounts, like sort of the house money market account, was north of 6%.
Yeah.
I mean, that's never been repeated.
Nope.
Since that time.
No, in more recent time, we got up to 5-ish.
Yeah.
But that didn't last long.
Mm-mm.
And I would argue there were 6% money market accounts for a much longer period of time if we go back to the late 90s, early 2000s, than existed in the 2022-3 range.
Yeah, absolutely. Mm-hmm. Yeah, and we're just pointing that out to say whole life insurance is not unique.
No.
It follows those other interest sensitive sort of assets, I would call them.
And but the one thing that it does have as a unique advantage is a pretty predictable path that will compound values over time. And we like to compare whole life to bonds. We've talked about it numerous times. We don't know that that'll happen with bonds.
Right.
In fact, if you're buying bonds directly, it's very hard to compound growth there. But buying bond funds doesn't necessarily work in a clear path either. So that is a uniqueness that whole life insurance has, and that compounding really, really works. It is substantially easier to get to $1 million or whatever the target is, if you're going to put premiums into a whole life policy for 30 years versus 15.
Yes. Yes.
And that timing really, really helps. I'll quantify it for everybody. Let's say you're going to own or pay premiums into a whole life policy for the next 30 years. You want $1 million balance of cash value by the time we get to year 30. And we're going to assume that the internal rate of return of that policy over that 30-year period will be 5%. The math is pretty easy for us. $15,000 needs to be the premium in order to arrive at that $1 million balance.
Right.
We'll get there.
Mm-hmm.
If you decide to wait 5 years, I'm not talking about 15 years anymore, I'm talking about 25 years. To get to $1 million, you're going to need $21,000 per year as the premium to get there.
Right.
Now, and it doesn't work this way, but let's just pretend it did. If by virtue of waiting 5 years, you could somehow magically increase the internal rate of return of this policy over 25 years to 5.25%, still going to cost you more, $20,300 per year to get there.
Right. There is no substitute for time.
No, there isn't.
And I just want to emphasize what you said. It's a pretty predictable path. Is it going to work perfectly? No, it's not. But again, the range of possible outcomes is much more narrow.
Mm-hmm.
Because whole life insurance works this way. Like out of the box. It's designed to do this.
And the people who get hung up on like, is now the right time to buy whatever ETF or mutual fund or specific stock, if you like to do that, there's still a lot of people who will buy. And some might look back 5 years from purchase and say, actually, I should have waited 6 months. But usually, even if they do that, they're still just fine with what their result is. And everybody knows that there's going to be volatility there.
Mm-hmm.
And there's a lot of volatility that you have to assume in that situation. Yeah. There is very, 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 very little volatility you have to assume with whole life insurance.
Right.
And this is not to say you should buy whole life insurance and not stocks. This is to say you should use whole life insurance to kind of buffer the downside and then buy stocks to take advantage of what stocks do.
Right.
That has always been the position here.
Whole life insurance it's a different asset.
Mm-hmm.
And it behaves differently. It's never going to be exciting.
No. But it's also not an asset that you have to worry a whole lot when it comes to timing.
Yep.
And if now is the right time. Really, the factors that come into is it the right time that we walk through with people is, well, how you doing work-wise? Like stable employment?
Right.
Do you have excess money at the end of the month? Or are you sitting on a certain sum of money that you'd rather deploy to something else? How are your debts? Like those are the things that would go into, is it the right time?
Right.
Not is the dividend projection or the outlook on where dividend's going to make this the right or wrong time to buy whole life insurance.
Right. It's much more of a budgetary discussion.
Mm-hmm. The getting things in order for you personally, not what the insurance company or the industry or the economy is doing.
Right. Absolutely true. Because we have no idea where dividend rates are headed.
Nope, we don't.
I think every prediction we've tried to make was wrong. So stop doing that. I mean, generally speaking, if interest rates go up and stay up for an extended period of time, you should see dividend rates ease. And I say ease upward.
Mm-hmm.
But we're not really living in that world at the moment. So
nope.
We saw them ease slightly upward over the last couple of years, but that was a couple of years after interest rates, as we did predict. It's not an instant thing.
Yeah.
Doesn't react that way.
Yep. And even though products like indexed universal life insurance are more variable in terms of year over year return, because they're tied to an index, that index could be up, it could be down, that does create some degree of variability in the actual earnings. The fact that there is still a fairly narrow band within which those returns will materialize. Like there's 0 on the downside and usually caps of like 10-ish%. That too makes the path much more predictable when it comes to indexed universal life insurance.
Yep.
Versus bond funds, stocks, things of that nature. Still, it's a fixed asset. It is not something that you're going to buy as a substitute to stocks.
Right.
In the sense that you're going to achieve some similar return. That's not going to happen. It is something that you would buy as a complement in the sense that, well, if things turn around and go badly, I want some degree of downside protection.
Right.
Stocks will offer very little. Indexed universal life insurance and whole life insurance will offer quite a lot. That's why you make that move. And again, timing the purchase of indexed universal life insurance is also a fairly foolish pursuit.
Yeah.
Because over time, the movement in that index is going to wash everything into an average.
Yeah.
I've had conversations in the past with people who have asked, what time of the year is the best time to buy into indexed universal life insurance? Like, where's the part where the market is historically at its lowest? And there really isn't an answer.
Right.
Yep. And
we did a podcast, I don't know how many podcasts ago, where we walked through all those numbers.
Mm-hmm. We did. And what we find is that over longer periods of time, there isn't a singular point in the year where it'll work.
Right.
There just isn't.
I would say we have them distributed, I won't say evenly, but they're distributed as far as anniversary dates all over the place with our clients, and they've all done just fine.
Yep. We haven't done it in a while, but we have also looked at the ones that have either paid monthly or used something like a dollar cost average account.
Yeah.
Which effectively meant their premiums were being kind of deployed as a monthly payment.
Mm-hmm.
That gave us more data to sit and look at, okay, which buckets have performed at what amounts. And from that, they're all pretty even.
Yeah.
So there isn't any one month or particular time.
Right.
That averages lower or higher. Even if there were one where we could say, yep, in May, the market goes down. So that's the time you want to buy. The problem is you'll have 11 months of possible rise, and then May will come back around and the market will come back down, and it just kind of averages out to what everything else does.
Right. Exactly. Okay.
That's it for today.
I don't have anything else to say.
Then I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.